Assalamu alaikum warahmatullahi wabarakatuh. Let me introduce myself. My name is Diki Andrian, NPM 234120061, from Class AKT 23A. Hello everyone. In this video we will discuss a very interesting and important topic in the world of accounting, namely common size analysis. We will thoroughly examine the definition, function, and benefits in financial statement analysis. So, make sure you watch until the end to get a deep understanding. Understanding common size. Common size analysis is a technique used to convert numbers in financial statements into percentages of a certain total. For example, in the income statement, each item is calculated as a percentage of total sales, while in the balance sheet, each element is calculated as a percentage of total assets. The main purpose of this approach is to facilitate the comparison of financial statements between companies or between time periods without being affected by the size or scale of the company. In other words, this analysis allows us to focus on the financial composition and operational efficiency of the company more objectively. As a simple example, if a company has revenue of 1 billion Indonesian rupiah and operating costs of 500 million Indonesian rupiah, then the operating costs will be represented as 50% of the total revenue in the common size analysis. This approach is very useful for understanding the company's cost and revenue structure more clearly. Functions of common size analysis. Let's discuss the main functions of common size analysis in more detail. 1. Comparison of performance between companies. By using common size analysis, we can compare the cost and profit structures between two companies of different sizes. For example, one company may have much larger sales than another company. However, with common size we can see how their operational efficiency compares proportionally. 2. Analysis of changes in financial structure. This analysis also helps assess changes in cost or asset structure over time. For example, if last year a company spent 40% of its sales on raw materials and this year only 35%, then we can conclude that there has been an increase in production efficiency. 3. Identify financial trends. Through common size analysis, we can easily identify trends in cost or revenue structures from year to year. Is there a significant increase in marketing costs? Is revenue consistently increasing? All these questions can be answered quickly using this technique. Benefits of common size analysis. The main benefit of common size analysis is the simplification of financial data. By converting numbers into percentages, we can understand the composition of a company's costs, revenues, and assets more easily without having to struggle with large numbers that are difficult to compare. In addition, strategic decision-making managers can use percentage data to determine which areas need to be optimized or reduce costs for operational efficiency. Company financial health assessment. Investors can evaluate the company's financial condition objectively and compare it with competitors in the same industry. Benchmarking. Companies can compare their performance with industry standards or closest competitors to find out their position and the steps for improvement needed. As additional information, common size analysis is also often used to find out whether investment in an asset is too large, overinvestment, or too small, underinvestment, compared to the industry average. This allows companies to take strategic policies to improve the efficiency of their use of funds. That concludes the discussion on common size analysis, a very useful tool for managers, accountants, and investors to understand and evaluate financial statements in more depth. Thank you for watching. Don't forget to like, share, and subscribe if this material is useful for you. See you in the next video.